The debt-to-equity ratio is an important metric used in corporate finance. It is a financial ratio that indicates the relative proportion of shareholders' equity and debt used to finance a company's assets. Let's find out more. The two components, equity and debt, can be found in the company's balance sheet or financial statements. Debt-to-equity ratio is closely related to leveraging, and when the ratio is used to calculate the financial leverage, we usually include only long-term debt. Generally speaking, a high ratio may indicate that the company is much resourced with outside borrowing, as compared to funding from shareholders. It also reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. The formula to calculate debt-to-equity ratio in its simplest form is debt divided by equity. Subject to interpretation, this can also mean long-term debt divided by equity, or even the company's total liabilities divided by equity, since all liabilities can be considered as debt. Also, preferred stocks can be either considered part of debt or part of equity. To include either in debt or equity is a subjective decision, sometimes related to the features of the preferred shares. Investors and analysts use the debt-to-equity ratio in order to understand if a company takes debt to finance its operations. A high debt-to-equity ratio is often associated with high risk. It means that a company has been aggressively financing its growth, with assuming more debt. This is not necessarily a bad thing. A company many times can take loans to finance operations and bring growth and increased revenues. If the debt cost and what the company pays in interest is lower than the increased business, then the net effect is positive, and the company uses leverage to expand and grow. If, however, market conditions change, this can have an adverse effect when the interest to be paid is greater than the increased revenues. With that said, when evaluating the debt-to-equity ratio of a company, we need to definitely consider the industry in which this company operates. Different industries have different needs for capital and financing. Capital-intensive industries such as in manufacturing may have significantly more debt than businesses in services, so the debt-to-equity ratios are totally different in this example, and this is completely normal. This was our basic introduction to the debt-to-equity ratio. To find out more, please look at the links in the description below. If you like this video, please hit the like button so that will help this video rank better and let more people discover it. Don't forget to subscribe if you haven't done so, in order to discover our upcoming videos with more educational content about investing, finance and business. Thanks for watching.